even in the prior repo spike, so that whole 2018, 2019 period, once you had an inverted yield curve, you had no more really significant foreign buying. That contributed to the T-bill oversupply problem. And we have a similar problem here. There's one is that, whenever the dollar is on the stronger end, you generally have less foreign buying of treasuries. Basically, they're more like defending their currencies rather than, cheapening their currencies and accumulating reserves. That's number one. And then number two, because of the geopolitical issues around Russia, a number of countries have made also, some degree of strategic decision that, they might want to be careful about how much they hold in treasuries because the United States could essentially shut off their money. And that's a separate issue from what you think of the conflict, but it's just that basically when sovereign nations realize that their reserves are subject to, bank freezes, essentially, right? I mean, if you're in a jurisdiction where your bank account can be frozen, you might think twice about how much you want to put in the bank. You might want to have some money in some of your self-custody, physical cash, gold, Bitcoin, silver, whatever, whatever you want to do. You might think twice about how much you put in your bank account. Similarly, sovereign nations are maybe thinking twice about how much they want to hold in freezable assets, and they either want to diversify, right? So Russia says, okay, we're going to hold money in Chinese, assets to some extent, or you have other countries say we're going to own some gold and we're going to self-custody it because nobody can shut off the gold if we own it. And so there's a combination of diversification and other assets, self-custodial assets, as well as just a general trend that when you do have a strong dollar, you generally get less treasury buying in general. So I think in the coming years, we're going to see essentially a deterioration in quality of the treasury market. So we've already seen over the past year really bad liquidity conditions. So basically, that the treasury market's supposed to be one of the most liquid markets in the world. That if you're a billionaire, you can come in and buy or sell $1 billion of treasuries, and it doesn't matter. You don't affect the price because it's a deep liquid market. And what we saw over the past year, and to a greater extent over the past few years, but especially the past year, is how poor liquidity was. Right? There's not a lot of buyers and sellers relative to the size of the market, and so it's easy to move the price around. It's easier for auctions to be messy, where they start selling at one price, and by the end of the auction, they're selling at a different price because there just weren't enough buyers to keep buying at that initial price. Um, and so my expectation is that treasury market liquidity is going to continue to be a problem as long as the Fed is not a buyer, because if you don't have foreign buyers, banks are no longer U.S. banks are no longer buying in aggregate. They were before, but they're not now. And there's only basically the buyers are things like pensions, wealth managers, households, family offices. You have these kind of domestic non-bank entities that are essentially buying what everyone else is either selling or not buying, and that can only go on for so long. There's only so much they can absorb relative to the size of their balance sheet, and then either you would have the Fed coming in back to provide more QE, essentially, kind of like what they did after the 2019 repo spike. Um, or another option that they can do is that they can adjust the supplementary leverage ratio for banks, which is a jargon for saying that they can change how banks calculate their leverage, but only for treasuries. It's a way of banks holding more treasuries, and it's functionally similar to QE, with the difference being that more of those end up on commercial bank balance sheets rather than the central bank balance sheets. So they have a couple levers they can pull if they run into liquidity problems, but all of those are generally pro-inflationary, and kind of generally would trend towards a weaker dollar rather than a stronger dollar. So I think that the labor market's going to weaken to a significant degree. Maybe not to the extent that say happened in 2008, but I do think that we're going to get more and more slack in the labor market. We're already showing signs of that rolling over. So, for example, right now, unemployment rate's still low. A lot of labor conditions are still strong. But when you look at leading indicators like temporary help numbers, for example, those have already gone down year over year slightly, and that generally leads broader employment, because if you're a small business, if you're trying to tighten your belt, the first employees you might let go are the temporary employees rather than your longer term permanent employees. And so we're seeing early signs of a weakening labor market. So I would keep watching out for that. That can certainly affect a lot of people, obviously. Um, and I think we're going to see, I expect kind of just stagnant markets, right? There are certainly possibilities where you could rally or you could crash. Whereas my base case is probably just stagnation in a lot of asset prices, where you just have a continued grind sideways or grind somewhat lower, for example, by the end of the year. And you could certainly have these more explosive moments. Like maybe, for example, in the first half of the year, if the market starts to price in a recession and you start to get a fall in bond yields, you could get a rally in risk assets. But then when the actual recession materializes and you get weaker corporate earnings, you'd probably give up a lot of that rally. So you could have a situation where you rally the first half of the year and then fall the second half of the year and erase all those gains. And so there's a lot of different directions that this could play out. But as long as you know, economic indicators point south, and as long as the Fed is withdrawing liquidity, you're unlikely to get fantastic asset price performance in most assets like equities. You had for a while, for years and years ago, you had declining gold balances among countries, and so from say the 80s and 90s all the way into say roughly 2008, you had declining gold balances, and then after the 2008 crisis, you've had a pretty persistent uptrend in gold reserves among foreign nations. It kind of it's like a V shape where you reverse that, and so that's the longer term trend. And then the nearer term, as you pointed out, I mean, 2022 was a great year for gold accumulation among these sovereign nations. And I don't see a reason why that would slow down. Ironically, a lot of sovereign nations hold their gold in London or in New York, which kind of partially defeats the purpose because then they have all that counterparty risk. But many of them do self-custody their own gold in their sovereign vaults. And as long as prices are pretty low, I mean, prices are like they haven't really gone anywhere in a decade. There's these large paper markets, and so they're saying, well, if the physical is on sale, we'll just keep taking the physical. And so as long as that works, as long as there's stockpiles, as long as they can keep taking the physical without adjusting the price too much, I don't see why they wouldn't keep doing it. And eventually they can run out of, you know, basically you start to get a pricing function if you run into acute shortages and you're unable to meet those requests. But yeah, I do think that they're going to continue to accumulate. And a lot of it is, obviously countries like China and Russia are going to, be more gold focused and less dollar focused because they're more likely to have direct adversarial outcomes with the United States. Whereas you have a lot of countries like Saudi Arabia, India, Brazil, where they're not strategic like enemies to the United States, but they want to have their own. They want to be able to choose their own direction. China is now the biggest trade partner with the majority of countries in the world. It used to be the United States, but over the past 20 years, that's flipped over to China for the vast majority of countries. Only North America, parts of Western Europe are still bigger trade partners with the U.S. Vast majority of these countries are bigger trade partners with China, and so they want flexibility to be able to go around and kind of buy and sell whatever they want and without, pressure from Washington. So I think even for those types of countries, there's a good chance that they want to be resilient to, potential sanctions or actions that could be done against them for siding with interests that the United States doesn't necessarily want. I mean, a good example was India, where, they were asked if they were going to stop buying Russian oil, and their like energy minister like pointed to Sri Lanka, and he's like, literally on our doorstep, we this country had severe energy crises. They basically had a collapse of their state due to lack of cheap energy, and so we're going to do everything in our power to get energy as cheap as we can. I mean, they're a country where per capita GDP is like $3,000 or $2,000. I forget the exact number. It's a very on a per capita basis impoverished country, and so they're not really pickers or choosers about where they get their energy from. And that's not necessarily something that people in Washington like. And so India wants to be able to maintain its own payment channels and its own stores of value so that it's not necessarily pressured by external nations. And I think that's true for a lot of the BRICS nations.